making statements. Well, we're in Burkina Faso, have been for many, many years. It's a great place to build mines. There's been 10 mines built there in the past, basically 10 years. There's another being built right now, and another one going to start in the middle of this year, and hopefully we'll be starting next year. I believe we're an emerging district. We have around about 5 million ounces of M&I. We've got West African beside us, and B2 have just announced their Tuega. So I don't know if anybody drops a compass in anything these days, but if in a 15-kilometre radius, you've got essentially 10 million ounces, which to me is a district, and flat as a pancake. So I think that at the end of the day, it makes sense that these will all be together, but we're marching ahead based on what we've got today. Great infrastructure, everybody talks about it, but we do, a lot of these mines that I just showed you in the last map, it takes about 8 to 10 hours on pretty rough roads to get there. We drive out in about an hour and 10 minutes on a major highway. It's 5 kilometres from the main highway. We have a quarry right beside us. We get main rivers. We've got a town there of Moctedo, which is about 15,000 people, where most of our workers will be in place. We've already built our roads. We've got our camp in place, 80-person camp, shops, offices, warehouses, light vehicle repair shop, fuel storage, all in place already, a major communication system. So all of that infrastructure is bought and installed. So we're really ready to go to the next stage of the project. There is a power line in place. It's a large power line, but we will not be accessing that. We've got a very low power requirement here. So for us, it really will just be HFO diesel for us. We have a large oxide and sulphide deposit, but we will be focusing on the oxides. It's about, I think the reserve will probably come in around 50 to 60 million tonnes. It's going to be around about 12 to 14 years of mine life. That is a huge oxide resource, all free digging, no drill and blast, and an average depth of 45 metres. The sulphide is definitely a warrant on gold. We're seeing some new stuff now, which I'll show you, and we think we can develop that longer term. But we've got 14 and hopefully more than that in the oxide. No drill and blast. We will be using a local contractor. We visited a number of mines that are using small 30-ton trucks, very efficient, very low mining cost. I can tell you that the waste cost for most of these are around about $1 a tonne contract on the ore, with including all technical services. All of the other things would be somewhere under 2. So with our strip ratio of 1.1, 1.2 to 1, we're going to have a very low mining cost with minimal capital from our side. We have a new flow sheet, which I'll show you, and that has significantly reduced the CapEx and the OpEx and has improved the overall recovery. So we're focusing on the oxides, and that's the shallow ore body. It's about a 55 degree dip here, and that's the same throughout the 11-kilometre strike here. And I want you to make note of that, because some of the new stuff that we are seeing is within that ore body, but plunging separately that we didn't recognize before. You basically mine up to the footwall. It's about a 40-metre width ore body, and you mine to the hanging wall. You mine to the footwall. It's very simple mining, all free digging. This was the flow sheet that they were contemplating. They were looking at a combined, previously management were looking at a combined heap leach and CIL. Capital cost was about 260 million. With the previous fiscal regime, it looked as if it had reasonable economics, about a 24% IRR. But once I get into the details here, it would really, with the team, it really was a very complicated flow sheet, and there was no need for it. So we've now, with our engineers, we're in the middle of feasibility study. I can tell you we're well into it at this point in time. We have removed the front end crusher and stockpile. The crusher was for the lower transition. It's not hard rock. It's about the hardness of this podium here, but you do need to break it up. It's about 3 million tonnes of the 60. So we're ignoring that. It's at the bottom of the pit. So that eliminates all of that circuit. By simply focusing on the free dig oxides, which are about 80% minus 150 micron, which is really what nature has done. It's made the ore body for you. No further work required. That eliminated the heap leach and all of the equipment that went with it. So all of that went and has been eliminated from the flow sheet. We went down and visited a mine that's very similar to this. We had all of the engineers on site in February, and this is definitely the flow sheet we're going forward with. And this is what it looks like. Straight up into a hopper. In fact, the way we're designing this, the trucks will drive right over it, 30-ton trucks. They won't even have to reverse to tip and dump. So drive in, drive out, so quick through the system. It will be designed so a front-end loader can drive over it if it needs to clean it. Straight into a mill. 80% of that ore will go right through the mill into the cyclones, 20% with a work index of between 2 to 4 kilowatt hours per ton. Average in Canada would be 16, 17. So low power requirement to grind that from around 250 micron to 150 micron. 24-hour leach time. We've completed all that test work now. So we'll have 6 tanks in there. Very quick leach. We get about 80% recovery in 10 hours. We've put a tailings thickener in, which gets the cyanide back, which saves us about $3 million per year in operating costs as well. What else have we done? Well, in the previous circuit, we had a heap leach and a tailings, which meant it was nested together. You had to build 100% of the tailings footprint up front, which meant that you had to pay for all the lining up front. So the upfront capital was about $8 to $9 million. We've eliminated that heap leach, which now allows us to build that in stages. Knight Peacehold, who are doing it, we may not actually even build that full footprint based on the current design, but assuming we do, we can build it in a number of stages. I've shown it here as stage 1 and stage 2, but it likely will occur over 4 stages. So our capex, it's not cut in quarter, but it's definitely below half from what the tailings was before. So all of that has been eliminated from the front end. And in terms of operating costs, I would say here I would be shocked if our cash costs were anything much further north of 300. I would be shocked if our all-in sustaining costs for the life of mine would be above 500. So the margins on this at $1,250 gold are very, very significant. A couple of things on the upside for it. We have been drilling new targets on the oxide outside of the main resource. We've also been drilling sulphides outside of it, which are shallow sulphides. There's district scale potential here. So we started looking at P17. We didn't know about it. The artisanals started to drill and blast once we moved them off the main deposit. They were leaching it, so it obviously had grade. That brought us into looking at certain models inside of the main deposit. So this is what we're seeing at P17. For a 1 gram ore body, you can see these are significantly higher. I would expect the resource here would be minimum twice the grade of the existing sulphides. It's still wide open. We're going to be drilling in between these 2 surface deposits that we've seen. And it will also lead us to drilling within the oxides. One other thing you'll notice there, if you look at that yellow with the red, that red is the major pit. It doesn't stop there. That's actually a seasonal river. There's 230,000 ounces of M&I sitting in there of oxide. The previous management didn't permit because it was going to take a little longer. They wanted that permit in before the fiscal regime changed. Didn't quite make it in terms of that timing. But we've now submitted a new mine plan, and we expect those 230,000 ounces to be reinstated, which will add another 2 years to our oxide mine plan. So that lower sulfide one, I showed you the previous, it dipped at 55. We thought this would be the same. It didn't. It dipped at 22. It was a granodiorite. Plunged at 22. It's a limb of a fold, multi-limbs. Very, very good grade, particularly where it folds. We get in the multi-grams. That brought us back into the oxide. And here is Siga. You can see some of the grades that we did see. That's all associated with that same granodiorite trend. Funny enough, the artisanals were in there as well. We've now drilled that. This one is about 650 meters long within the existing pit. You'll see some of the hits that we're seeing here, 3.4, 32 grams, 9 grams, 14 grams, on an average ore body of just under a gram. So you can see how sweet these grades are. We were modeling it as if it was dipping at 55. We're now modeling it plunging at 22. We've got several of these. We continue to drill them. We expect that they will be remodeled and in a new resource in Q3 of this year. That will be after the feasibility study, but that will again add to what we see. And these are all free digging oxides, same metallurgy, same recoveries, no different than what we're mining within the main pits. This is what we've been drilling recently. You can see again, we're hitting in between those high grade hits and we're hitting the same material. Up north, again, the artisanals, and this is another part of the deposit. We didn't finish off this drilling. This one's now got a strike extent of about 850 meters down plunge. And you can see the grades that we are hitting. And this is our recent drilling from those areas. So you can see, again, the type of grades averaging between 2 to 14 meters wide. What that really will do is just brings up the grade within the pits. And we expect that about 5% of our overall 60 million tons will be these high-grade tons in the next resource. So a big sweetener to the ore body going forward. If you take a gram and make it 1.2, that 20% is free to your bottom line. And it's huge in terms of the IRR and the NPV of the project. So, and that we think these systems extend down into the sulphides, and we will continue to drill those this year. We will have, besides going forward with our feasibility and going into the detail engineering, we will also be doing extensive drilling on the deposit going forward in the oxides and down into the sulphides as we move forward here. We think this is a lot of life left in this project. So complete the feasibility study. I expect the capital to be somewhere in the 140 to 150 range from, it was previously 260. So I think we've reduced that by over $100 million. We've got Lycopodium, we've built several mines in Burkina and West Africa doing this for us, who've got current costs from the Natugu project that they're building for Semifo. So we're pretty confident about where we're going with the CapEx and OpEx. We will continue to model these higher grade zones and continue to drill them. We will apply for that 240,000 reinstatement going forward, and I expect that will come back into the resources and the reserves over the next 6 to 8 months. The near oxides and sulphides, we're still open on oxides and we're still open on sulphides. And I think you'll see over the next actually few days that we're going to be strengthening our corporate team going forward. And we're very well financed to advance this project, and we've had a number of people in terms of the next stage of debt and equity look at it, very enthusiastic about it. So I think we can build this. Eric says that, this is not a $300-400 million capex, but as I say, we're in a district, and if it's going to be consolidated, we think we're going to be one of the players in that consolidation going forward. Okay, thank you.